So I think that's partially going to be a policymaker decision. Depends how much they want to fight inflation versus, keep the economy somewhat on track. So predicting that is partially predicting what Jerome Powell is going to do, what Congress is going to do, whether they might jump in with fiscal support or not, and what timing around that. So I'll be the first to say that I don't know the answer to that. If we look back at a number of recessions, I think the dot-com recession is instructive here because there were similarities with these types of assets that were very euphoric, right? The tech sector, especially the unprofitable tech sector, that was clearly a bubble both that time and this time. What made that recession interesting is it was actually a very mild recession by most indicators. So that the 2001, 2002, 2003 period was very soft economically, but you had generally less unemployment than recessions that came before it and recessions that came after it. It was one of the more mild ones. So I think it's certainly possible that this could be along those lines, where it's not the gigantic recession that we've been accustomed to in the past, the global financial crisis and the COVID shutdowns. But I mean, there are certainly policymaker choices that could exacerbate it. I mean, if they mismanage how they run the money, because we have a very centrally managed money system, you can certainly cascade into more and more losses. And it's also going to depend on how quickly things like AI can ramp up. But generally, I'm looking less at one of those big deflationary collapse type of recessions, and I'm looking more at a stagflationary type of recession. But we'll as data comes in and as policymaker decisions come in, we can get more clarity on maybe how severe this might turn out. So I think right now, in the next several months, we've been in a disinflationary cycle. I think we're going to continue to be in a disinflationary cycle. Now, in the 70s, for example, you would have inflation come down from a high level to a level that is still pretty high. And so inflation doesn't always go low in recessions. It just always, historically in the US always goes lower. If you look at internationally, if you look at when you see emerging markets have recessions, sometimes they have a massive inflation breakout during recession because their currency works differently, right? Because they have liabilities that they can't print, and therefore they tend to experience different types of recessions. One thing that makes this period interesting is that there are tighter energy constraints now, and so you could have environments where Europe and the United States almost experience like an emerging market type of recession. That's more of a stagflationary type of recession where, on the demand side, you are experiencing a degree of disinflation, but it's not as though you're now completely oversupplied with commodities and all those things get super cheap. They could still be somewhat elevated in price while you have ongoing economic contraction, stagnation, things like that. So again, giving an exact number is partially depending on human policymakers, but the way I would phrase it is that the constraints that are causing inflation to contribute to inflation are still there. And so all the money that was printed is still mostly in the economy, especially now that I think we're getting towards the end of quantitative tightening. That removed some money that was printed, but only a small portion of it. Most of the money that was printed is still out there. We still have not had really a CapEx cycle in energy or commodities. We've not brought new copper mines online at scale. We've not brought new oil fields online at scale. We're seeing some obviously development around LNG export capacity to, for example, reduce Europe's reliance on, now that they've been severed from Russia, they need more LNG. So obviously there's work being done.